Want to invest in mutual funds but confused about which one to choose? You're not alone. With so many options, equity, debt, hybrid, it's so easy to get lost. Some say equity funds are the key to wealth creation, while others swear by the stability of debt funds. So, which one is the right one for you? That's exactly what we'll figure out in this video. By the end, you will know which type of mutual fund aligns with your financial goals and risk appetite. So let's get started. Mutual fund comes in various categories, but at the core, they are broadly classified into two types: equity mutual funds and debt mutual funds. Each serves a different purpose, caters to different types of investors, and carries its own levels of risk and return potential. Let's understand the key differences that will help you decide which one suits your financial needs better. Equity mutual funds, what are they? Since stocks are the primary investments of equity mutual funds, the performance of the stock market directly affects your money. They are therefore high risk, high return investments. You benefit if the market performs well, but your investment may suffer if it crashes. Now, there's no one size fits all category for equity funds. They are categorized by sector focus, investment style, and market capitalization. Some equity funds invest in large cap stocks, which means they put money into well established stable companies. These funds are less risky and provide consistent but moderate returns. Then there are mid cap and small cap funds, which invest in emerging companies with high growth potential. They carry more risk but can generate significantly higher returns over the long run. Equity funds also differ in management style. Actively managed funds, fund managers select stocks with goals of outperforming the market. Passive funds, these include index funds and ETFs that simply track a specific index such as the Nifty 50 with little intervention. Then there are sectoral and thematic funds, which target specific industry like technology, healthcare, or banking. While these funds can provide excellent returns when their industry is thriving, they are riskier due to lack of diversification. Equity funds are ideal for long-term investors who can adapt to changing market ups and downs. If you plan to invest for at least 5 years, equity funds can help you generate significant wealth over time. Anything short-term? Then equity funds should not be your choice. Instead, stick to debt mutual funds. Unlike equity funds, debt mutual funds do not invest in stocks. Instead, they put money into fixed income securities like government bonds, corporate bonds, treasury bills, and other debt instruments. The goal here is to provide stability and predictable returns rather than aggressive growth. Debt fund comes in different types based on the kind of securities they invest in. GILT funds invest in solely government securities, one of the safest options but with lower returns. Corporate bond funds, they invest in debt issued by companies and provide slightly higher returns, but they do carry some credit risk. PSU and banking debt funds, they focus on public sector and banking bonds, providing a balance of safety and returns. Another important factor that distinguishes debt funds is the maturity period. Short-term debt funds, ideal if you want to keep your money for a few months to a year. Long-term debt funds, more stable but subject to interest rate fluctuations. Debt mutual funds are ideal for conservative investors or those seeking short-term investment options. If you don't want too much risk but still want better return than a savings account or an FD, debt funds are an excellent option. Now let's talk about taxation. One critical factor often overlooked when choosing between equity and debt mutual fund is taxation. How your returns are taxed can significantly impact your actual gains. For equity mutual funds, if you sell your investment before 1 year, the profits are taxed at short-term capital gains at 20%. But if you hold your investments for more than a year, the gains are subject to long-term capital gains at 12.5% on only those profits above 1.25 lakhs per year. For debt mutual funds, according to the recent tax changes, returns from debt funds are taxed at your income slab rate regardless of the holding period. This means if you are in the 30% tax bracket, your gains from debt funds will be taxed at 30%, making them less tax efficient for high income earners compared to equity funds. So, how do you choose between equity and debt funds? Investment goals. If you want to build wealth over the long run, go with equity funds. If you want stability and consistent returns, choose debt funds. Risk tolerance. If you can handle short-term fluctuations for long-term goals, equity is your best option. If you prefer secure, predictable return, go with debt funds. Time horizon. 5 years or more, go with equity funds. 1 to 3 years, opt for debt funds. Tax efficiency. Equity funds are more tax-friendly for long-term holding. Debt funds can be less attractive for high-income earners due to slab-based taxation. So, which one should you go for? There's no one-size-fits-all answer. If you are young with high risk appetite, go for equity mutual funds. If you're seeking stability, stick to the debt funds. Here's a pro tip: diversify with both. That's it from me. I'm Nikhil Varghese. Share this video and subscribe to learn how to make your finances less tricky with FinNiki.